All right, so welcome back to Coffee Cafe. I think we just barely started the adjustments. So a few things that we will be taking a look today is a few more adjustments as well as depreciation, and then we'll move on to completing our adjusted trial balance, okay? It is very, very important that we get the adjusted trial balance correct so then we can move on to completing the financial statements. All right. So this is where we last left off. So what we just did our bank reconciliation, right? As you can see here, we entered and updated our books to match our statement here. All right. And all right. So here, this is where we last left off. So in this case, we received, or in this case, we printed out our credit card statement from National Bank Visa. Okay, so here's all the information to what's going on to this account. Here we have right here our statement due date. Okay, I'm sorry. First is the statement date, and then the due date is July 10. This is what we have. All right. We have a total of $18.85 and 89 cents balance. We have a total of 18% interest for the month gave us a total of $28 and 29 cents. And then so our current total balance is $19.14.18. Okay. And here what I want you to do is for this bill, we're going to assume that we're going to pay the entire account balance on the due date. Okay, so that means we're not going to pay now. We're going to choose to pay later. Okay, and it says right here, use interest payable to reflect the interest accrued for this transaction. So let's go ahead and dive right in. So how should I record that I owe money? How should I record that I received a bill and that I owe on my credit card and that I will pay it in the future?
Your accounts payable.
You're going to transfer the entire account balance into accounts payable. Good, excellent. All right. Now, how much is going to go to accounts payable?
$1,885.89.
Excellent, because in this case, that's correct. $18.85.89 is what I owe on the credit card. What else do I need to recognize?
The interest.
We have to recognize the interest. Now, in this case, okay, so this is wrong. Okay, so we said we're going to recognize accounts payable, so that's one of them. Since we're going to be increasing our accounts payable, we're going to be crediting the accounts payable, okay, for the 18,885, okay, 89, okay? Now we have interest. Now, which interest are we going to be using? Are we paying the interest now or are we going to pay it later?
Pay it later.
We're going to pay it later, so that means it becomes a liability, right? So then let's go ahead and take a look. What account do I have that reflects interest that I pay later?
$27,500.
27,500. So in this case, I'm going to be increasing because I owe money to interest expense. In this case, since I'm not going to pay it now and I choose to pay later, I'm going to be recognizing that I owe interest, okay, which is $27,500. Okay, and how much is my interest? $28.29. Okay. Now in this case, right, because I received a bill and I choose to pay it later, what's going to happen to my Visa credit card? What's going to happen to my Visa credit card? What's going to happen to my Visa credit card? Right now I owe $1885.89. What's going to happen to it if I choose that I accepted the bill and I'm going to pay it for it later? You're increasing your accounts payable, but what are you decreasing? You're zeroing out this account because you accepted that this is how much you owe and you will pay for it, just not now. So what I'm going to do here is I'm going to transfer this amount into my accounts payable because I'm accepting that this is what I owe on my Visa and this is what I'm going to pay on my Visa. So in this case, I'm going to be transferring this amount out. Okay? And last but not least, what else do I need to recognize? Because this is how much I used on my credit card. I didn't put interest in here. Why? Because interest doesn't belong on a credit card, does it? Even though it shows up on your credit card, but what does it actually show up as? You didn't buy interest expense, did you? So how are you going to recognize interest?
Interest expense?
You're going to have it as an interest expense for the month of June. So in this case, this was my credit card statement. This is how much interest I collected this month. So therefore, I'm going to recognize that it's a separate form. It's my agreement for using this credit card is I am subject to have to pay this amount. Okay? 65.50, right? For a total of $28.29. So in their case, we have everything that we need, right? We have the credit card, right? And we're moving it into accounts payable because we accepted that we have the bill, but we're choosing to pay it later. All right, and we're accepting that this is how much interest that we accrued. I'm not paying it now. I'm going to pay the interest later. Okay, so this is one way that you can journalize this. Okay, second option that you could have done as well is since I'm not going to pay it now, this is one of those transactions that could potentially be a zero transaction or a non-cash transaction because in this case, right, did you pay for it? No. Will you pay for it? Yes, I'll pay for it later. So in this case, you could choose to pay it later, and when you pay it later, right, then you can record the transaction right then and there. However, this is another way that you can do it where I'm making a record that, hey, at least I know I have some liabilities ahead of me, that I owe money. Even though I received the bill, I won't accidentally forget about the bill until later on when I actually pay for it. Because this is also going to be something you need to update your subsidiary ledger as well. Okay, so in this case, this is just one of the options that you can do. Again, if you choose to record it later when you pay, that's also acceptable. The only difference here is instead of having payables, right, you just have your checking account right there to pay for the Visa payable and to pay for the interest expense that you've incurred. Right? That's the only difference between the journal. But since I've already recorded it and I recognize that I received a bill and I don't want to forget about it, this is how it would look like. All right? So what piece of information do I have here? Right? This was National Bank Visa. Statement. And then that's pretty much that's pretty much it. That you don't have to do anything else. Okay. So what's next? What's after the journal? The ledger. Okay. So let's update my ledger account. So in this case, I have Visa payable, which is where I just left off. And I'm going to go ahead and put the date in here. I'm going to put you could put your bill statement, balance, okay. I don't know, whatever you want to put here. We're on general journal number 22 here. And I'm going to debit my account for the $18.85 and 89 cents. So therefore, that should drop your account balance to 0 because we're going to plug it into my accounts payable. So what you could do too is you could go ahead and do that now, so then you can have it right here since it's right above here. You can say, right, Visa Gold statement, and increase it by $18.85.89. Okay. So you should owe a total of $5,771.10. Now, in this case, right, I said I'm going to make a payment. I'm going to pay the whole entire thing when the due date arrives, right? If you choose to pay the minimum payment, then you can recognize the minimum payment as what you're going to owe later on instead of me putting out the whole entire thing. Just make sure that when you do make a payment and you do make the minimum payment, that you are splitting it for the interest expense first, and then whatever amount that you have extra is going to actually go towards your credit card. So that's the rule of thumb when it comes to paying credit cards off. You pay the interest first, and then anything after that is going to go towards the actual credit card principal amount. Okay? So, but in this case, I'm going to choose to pay for the whole thing. So that's what I'm going to recognize is I am going to recognize the whole thing. Now, what if you can't tell that I'm going to pay for the whole thing? Then you can wait till the due date, then recognize it, and then choose whether you want to pay the minimum above the minimum or pay $200 instead of the whole $1,885. Okay? You have the choice. Okay? Do not do this where you record the entire bill and then you choose to only pay a portion of it. That's not how this works. This case, I told you I will make a whole entire payment for the entire credit card on the due date. But if you choose to make a small portion payment, then you don't need to transfer all $18.85, and I would recommend you wait till the due date or when you choose to pay the entire amount to write off and record this transaction. Okay? That's just a rule of thumb here. So there you go. I plugged in my accounts payable already by adding the $1885.89. Right? Next I have here is interest payable. So I'm going to scroll down here. So here we are, interest payable. You can write Visa credit card interest, which was 18%. Okay. And we got it for $28.29. Okay. And then last but not least, we need to update my interest expense account. So interest expense. Okay. Here we are, interest expense. And then you can also say the same thing, Visa credit card 18 interest 18% for the 28.29. All right. So now that we finished the ledger, what's next?
The subsidiary.
You need to update the subsidiary because you received a bill. You owe money to National Bank Visa. So I'm going to go ahead and head over to my window over here. National Bank Visa right here, National Bank Visa. Now you could choose to either fill in this one. You don't have to just because this is, I'm going to do another transaction. So in this case, I'm going to say that today is the 30th, right? We have our June statement, okay? Or you can say statement ending June 30th. I'm going to say my interest that was charged was 18%, which gave me a total of $28.29. Okay. Okay. No invoice. Post reference, General Journal 22. When is the due date? Or in this case, it says net 10. So when is the actual due date on my credit card? Okay, so in this case, it's supposed to be, it's due on 7/20. So in this case, 7/20, right? My whole entire invoice amount is going to be oh, sorry. Yes, 7/10 is when the due date is. This one is for 19/14/18. All right, and that's what I owe on my credit card, including the $28.29 interest. Okay. All right. So now that we recorded this, we are done with recording the that transaction, the credit card. Right? So now we're going to be starting on a new page, General Journal number 23. So let's see what has happened next. Okay. You end up receiving a bill from the bank. From the bank. Okay, for the truck loan. Okay, if you remember, we got a truck loan which was approved by the Maine Bank of Nevada, right? So here's the loan statement. Okay, so here's all the information that you need. So here, here's the June 30th statement. Number of payments left. We still have to pay 36 months, right? Because we signed a 3-year contract, right? This is our first payment, so we still have 36 payments left. Our principal was $29,291.90. We were charged 3% interest, which yielded $73.05. Okay. So now my current balance is $29,294.95. Okay. In this case right here, the due date again is going to be the 20th of July, and the minimum payment is $849.81. Okay. Now, of course, we're not going to pay it today. We're going to choose to pay this later. Okay? So we're just receiving the bill because we have 20 days to pay for this. So in this case, an $849.81 is a lot. So we have 20 days to pay for this off. So in this case, it's going to be very similar to the previous one. So how am I going to recognize this one now? However, I am going to pay the minimum payment because that's how much I have to pay every single month. They already figured out the numbers for me, so this is how much I'm going to pay. Okay? But I'm not going to pay it now. I'm going to choose to pay it later. So how am I going to record this transaction this time?
Would it come out the same way, except instead of the Visa payable, it would just come out of the truck loan?
Correct. Correct. But there's slight other differences as well. Okay? 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 So yes, you'll have a truck loan. And yes, you'll have interest expense. Yes, you'll have an accounts payable because you're going to choose to pay for it later. Okay? And yes, interest is separate. So you are going to choose to pay the interest separately. Okay? So in this case, my truck loan, what are my account numbers for these? So truck loan, $28.20. Interest expense was $65.50. We have accounts payable $20,000 and interest payable to be $27,500. Okay, so in this case, right, how much money is actually going to go towards my actual loan? If I'm going to make my monthly payments, because again, this is already figured out for you. This is what the bank tells you that you have to make the payment for. You can choose to pay over, but in this case, that is the bare minimum. You have to pay $849.81. So how much of that is actually going to go towards the truck loan, and how much of it is actually going to go towards interest?
$29,201.90 for the loan.
Well, you're gonna pay the whole 29,000 right now?
No.
No. How much are you required to pay?
$849.81.
Now, if you remember the rules of how loans work, is all of that going to go towards the principal?
Perhaps. No.
No, you can't. You have to pay the interest first. So in this case, how much is actually going to go towards the interest? How much was interest charged? The $73.05, right? That's how much interest was charged for the month of June, right? $73.05. So how much of the $849.81 is actually going to go towards the principal? How much is actually going to go towards the loan? Not 840. Remember, rules of paying things off. You always pay the interest first, unless you make a second payment. In this case, this is my very first payment I'm making on my truck loan. $849 is a very high payment, but it's because I got a low interest rate. Okay? So in this case, if I have to pay $849 every single month, right? But the rule here is you always pay interest first. So how much of this $849 is actually going to go towards my actual truck loan? If I have to pay interest first.
I got $776.36.
Good. $776.36. So your $849.81 payment, you're paying the interest off first of the $73, and then whatever is remaining is going to go actually towards your principal. It is only the second payment you can choose to pay towards the principal 100%. But that's the rule. You have to know this, right? Whether it's a truck payment, a loan payment, a business loan payment, whatever it is, it's always the second one you have control over how much of it is actually going to go towards the actual principal. The very first payment, you automatically must cover the interest first. That's the rule. Okay? So in this case, out of my $849.81, only $776.36 is actually going to go towards my truck loan. So therefore, right, that's going to be the same two numbers. Yes.
I got 776.76.
849.81 minus 73.05. Okay, yes, 776.76 you said? What was it before? Oh, I think I put 41 cents instead of 81 cents. Thank you. So there you go. 776.76 and then $73.05 for the interest. Okay? And now that we have all our information here, what I can go ahead and proceed. So this is Main Bank of Nevada. Okay, and this is truck loan statement. Okay. All right. So now let's go ahead and go to the ledger. Okay, so we have a truck loan, an interest expense, accounts payable, and another interest payable. So here, I'm already on interest expense, so might as well just go ahead and pop it in here. Okay. You can write truck loan, 3% interest. We're on the 23rd payment here, and it's for $73.05. Okay. So in grand total, how much interest have I paid for the loan that I made? Okay, plus the credit card. How much interest have I paid for the month of June?
I got 101.34.
$101.34. See? And that's where a lot of the times, if you're not very careful, this is what happens. I just lost $100 paying extra for the things that I borrowed. Okay? All right. Then we're going to go to liabilities. Okay. Here, I left off with my interest payable, so I'm going to go ahead and fill that in right there. Okay. Interest payable, so you could say truck loan, interest 3%, general journal 23, and I racked up another $73.05, which is the same thing as your interest expense, so you should have the same amount. Hold on. What did I put my interest expense as? Okay, interest expense is supposed to be debit, excuse me. Okay. All right, so that's my interest payable is a credit for $101.34. You could go ahead and scroll down since my truck loan is here anyway. Here you can say you got your truck loan statement. And you're going to make a payment of $776.76, which will reduce your account to be a total of
$28,445.14.
good. Right? That's how much you now owe on your truck now that you're going to make a payment for $849.81. Okay? And you also need to update your accounts payable because you're choosing to pay it later. For 77676. Oops. 77676. So now you've increased your liabilities once again to now to be $6,547.86. So what you did basically, you transferred the amount of what you owe into another account where you will pay it, but not now. You will pay it within, 30 days. Right? Again, this also has the same feature too. If you decide not to pay now, then you can choose to pay for it later. Just remember to identify that when you do make a payment, right, that you do insert, the truck loan and as well as the interest expense and make the payment right then and there forever how much you owe. Okay? But in this case, right, we at least recognize that we have something that we owe and it's going to be for the truck loan. Okay? Okay. So of course, we're going to go to our subsidiary ledger because we need to update our main bank for the truck loan. So as you can see here, we have the main bank for the overdraft protection, okay? And then we have right here for the truck loan, okay? And let's go ahead and plug it in here that we received the bill and this is how much I owe now. So in this case, truck loan, 3% interest, okay? And what you can do here is because I already entered in that I borrowed the 29,000, you can go ahead for this one. You are able to insert the interest amount in the amount. So in this case, the $73.05, you can just put that there because in this case, I have an amount that I am going to that I've already, I borrowed 29,000 where the Visa payable, you don't know how much you borrowed, right? That's going to be relative because you're charging as much as you go. You have a $10,000 cap. However, you're not going to, but that in this case, that's variable. In this case, we have a flat rate. So in this case, all we're actually recording here is just the interest that you've collected, all right? And therefore, you owe an additional $73.05. So when you do make a payment, right now it says you owe $29,294.95, which is correct. That's what your bill statement does say, right? When you make a payment to this truck loan, then it will reduce it that way. But make sure you do make some kind of indications that these do belong to each other. Okay? All right. And that is it for that transaction. Okay? Okay. So here we need to replenish the petty cash fund. How do we replenish the petty cash fund? Okay, so in this case, this is the petty cash manager. So in this case, the owner borrowed, I don't know, $200 to buy for pizza, which he gave back the receipt of $187.16. Okay. We had Irene buy the grand opening cake for $23.80. And then we had here Albert taking money to buy some decorations for the grand opening party. Okay, if you remember, this was on the 23rd, which was Sunday. All right, so in this case, this is the total amount of receipts that are in the petty cash drawer. So how do I replenish the money in the petty cash? Okay.
Write a check.
Write a check. Okay, so in this case, that's exactly correct. We're going to write a check. Okay? For how much?
Amount of the receipts.
The total amount of receipts. So in this case, how much is my total amount of receipts? You got 187.16 plus 23.80 plus $71.82. How much is in my grand total for my receipts? 282.78. Okay, good. So that means I need to have an equal expense. Now let's take a look at my chart of accounts. What kind of expense would these transactions fall under? Okay. Is this advertising expense? No. Is this a bank fee? Definitely not. Is it a business expense? It's possible. But let's go through all of the expenses before we decide it's a business expense. Is this a freight expense? No. We didn't pay this. We didn't use the petty cash drawer to pay for, freight, shipping for purchasing inventory. This is an insurance expense. This definitely is an interest expense, okay? It is definitely not a labor expense, right? We bought a cake, pizza, and decorations, so that's definitely not labor, okay? It's definitely not a license and permit expense. It's definitely not a loss on a disposal of asset. It's not office supplies, right? Is a cake office supplies? Definitely not. Payroll expenses. We're not paying our people to go buy these things. Okay, purchase expense. Obviously, we're not buying inventory. It's not rent. It's not travel. It's not utilities. So, and it's none of the bad debt. Those are all adjustments. So in this case, which account would this fall under?
The business expense.
It would fall under the business expense. Okay, business expense, I believe it's 6,200. 6,200. Okay. And then we need to cut a check, don't we? So you're going to go to check register. Okay. And we're going to be using check number 1533 for the 252 282.78. And then again, you can make this to the petty cash or whoever is in charge of the petty cash. Your choice. Okay. Right? To replenish petty cash fund using check number 1533. Okay. So in this case, where do I need to go to next? Where do I need to go next? I finished my journal.
Ledger.
I gotta go to my ledger. Okay. So in this case, let's go ahead. Let's see what's first. Business expenses. So, go to my expenses account. Okay. Here we are, business expense. You can say party supplies on June 23rd. Okay, if you want to be specific, you could say you bought a cake, pizza, and decorations. Okay, using petty cash. And we did it for $282.78. So therefore, how much should be my total expenses now for business expense?
$12.82.78.
$12.82.78. Good. Okay. And then last but not least, we got to go to our checking account to subtract that amount from my books. Right? I should make sure I'm in the right account. Checking. Okay. Check number 1533. And I made a payment for $282.78. Okay. And therefore should drop my bank account down to $13,142.60. Okay. In this case, do I need to go refer to my subsidiary ledger?
No.
No, because no one owns my petty cash except for me. So in this case, this didn't have to deal with any vendors outside of my business. Okay. All right. All right. Then it says here, estimated allowance for doubtful accounts, okay, based on a 5% of accounts receivable balance. So in this case, this is an estimated allowance for doubtful accounts, okay, which is based off of 5% of accounts receivable balance. So what does this mean? It is an estimated amount of accounts receivable based on a 5%. Anybody? Do you remember this? This was 10.1. It is an estimated amount. of accounts receivable.
It's like the 5% that you're allowed to write off.
Mm-hmm. But what am I writing it off as?
Like future losses.
Okay.
As bad debt.
You recognize this as bad debt because there's the criteria. Do you know who's gonna fault on their payment? No. Do you know how much? No. That's why it's estimated. Do you know when these people are gonna fault on your payment? Absolutely not. So in this case, this doesn't happen during the period. This is an estimated amount that in the future, yes, you will lose 5% because let's think about it. Realistically, we don't know the lives of our customers. We don't know what financial circumstances they have, right? All we care about is can we provide them goods and services? Can they afford it? If they applied for a credit or account or if they just agreed to the terms, then yes, and they agree that they owe us money. But realistically, can we expect 100% of our customers to be diligent and pay us back? No. And that's why the government lets you take up to 5% because they say realistically, a lot of businesses, right, if especially when you tailor your accounts to low income families, right? Letting them make it affordable for anybody to have an account with you, then your risk of, you know, your customers not paying on time or faulting on their payments is very high. In this case, they allow you to take 5%, okay, every year because of the assumption that not all your customers will pay you, especially with the given circumstances that you don't know their financial circumstances, right? There could be a financial upbringing, economic loss, whatever reasons that there is, right? You can't control what the customers do. Okay, so in this case, that's exactly correct. We are going to be having the bad debt, okay? Because it's something that we do at the end of a given accounting period. Okay? So what account number is my bad debt expense account? $65,000. Okay, and then what should be my credit account? What is this estimated amount of? Okay, it's about my accounts receivable. But what happens when my account receivable becomes uncollectible?
The allowance for doubtful.
It becomes a part of the allowance for doubtful accounts, correct? Right? It becomes potential bad debt. Right? So in this case, the allowance for doubtful accounts, okay, chart of accounts, it's a contra account to an asset. So in this case, 11,100, right? It's a contra account to my accounts receivable. Okay. Now, how much is going to be 5% of my total accounts receivable? How much is 5% of my accounts receivable? Where do I need to go to find out my account receivable balance? You need to go to your ledger to find out what your current accounts receivable balance is. So in this case, here we are. Accounts receivable right here. Right now, I have a total of $1531.95. So how do I calculate 5% of that? What is 5% of my total accounts receivable? 76.60. Okay, that's potential bad debt for me. Okay. And my note here could be potential bad debt, which is 5% of accounts receivable balance. Okay. Or you can write to write off bad debt. Could be a better one too. To write off bad debt, 5% of account receivable balance. Right? Okay. So right now in my accounts receivable, this is my balance that I currently have, right? But however, I need to fill in my allowance for doubtful accounts because again, this is a contra account. I didn't move my amounts in there because people still owe me this amount. However, this potential bad debt basically is like saying that out of this potential bad debt, right? 70 of those dollars could be uncollectible. We just don't know when. Right? So in this case, I'm going to write 5% of accounts receivable balance. Which in this case, right, it's a credit balance of $76.60. Right? And because it is a credit balance here, we need to also debit our equal and opposite debit for the bad debt expense for that $76.60. So here we are, bad debt. 5% of accounts receivable balance for $76.60. And once again, we don't need to put this on our subsidiary ledger because the accounts receivable and the allowance for doubtful accounts, this is internal, right? We don't have anybody that we are dealing with when it comes to transferring this amount over, right? It's an internal transaction. Okay. All right. So our next step here is we have to calculate 1 month of depreciation on the truck, okay? Its mileage is 150,000 miles, okay, before it needs to be maintenance, okay? No salvage value, and the useful life is 7 years. Okay? And of course, this month we drove a total of 1,200 miles. Okay? So this is where we're going to be using our depreciation tables. Okay? So let's look at my depreciation tables. This one I am doing for my truck. Okay? So I'm going to find my truck. I think it's here. Here's my truck. Now, which depreciation method am I going to be using? If the given context is I have that the mileage is 150,000 miles and I drove 1,200 miles this month. Which depreciation method will I be using to calculate the depreciation for the truck?
Double declining?
Not double declining.
Straight line?
Not straight line. Now, here is a hint. You're given a total of miles that this car can drive up to before it needs to be maintenance. And you're also given that this month you drove 1,200 miles. Straight line says that you're going to take the total amount and divide it amongst its estimated useful life. Okay? Double declining says that you're going to use the asset way more in the beginning of its life than towards the end of its life. So you would depreciate it twice as fast.
Activity method?
Activity-based method, because in this case, how many total miles can I drive? 150,000 miles, right? So that means this truck can drive pretty far. And for the month, I only used 1,200 miles. So in this case, that's exactly what we're going to do. We're going to do units of production, also known as activity-based, okay? Because it's based on how many miles I drove. So I'm going to put UOP for short, okay, for units of production. Now, let's see. I know for a fact I can drive up to 150,000 miles, okay? We know salvage value is 0. Do I have the date that I placed into service? Do I have the asset cost? Okay. All I know is for the month of June, I've already driven 1,200 miles. So in this case, where can I find the asset cost and when I place into service?
Subledger?
Not the subledger. What lists can I find my fixed assets? If it's not the journal and it's not the subledger,
About the general ledger?
it'd be the general ledger, right? Because that will list out all of my fixed assets with their respective account balances. So in this case, I'm going to go to my ledger, okay? And we're going to locate my fixed asset, which is my truck. Okay? So it's going to be towards the end. Okay? All right. So here we are, my truck. My truck I purchased it for $28,900 plus the taxes, plus the documentation fees to give me a grand total of $32,208.90. So that's how much my asset is worth right now. $32,208.90. Right? $32,208.90. Okay? Now that I know what that is, when did I place it into service? Okay. Let's check out my ledger. When did I actually buy it? When did I buy the truck? June 8th. What's the rule when do you depreciate the truck? Okay, what else? Why would you depreciate on June 8th? What's the rule? If you buy a truck or buy a car, when do you start depreciating it?
Is it since it's before the 15, you count the whole month of June?
Correct. But when do I exactly start to depreciate it? Because right now, I may have purchased it on June 8th, but that doesn't mean anything because the purpose is when you place into service, right? However, what is the rule? When you buy a car, when do you start depreciating it? It's a very specific rule.
As soon as you start using it.
As soon as you drive it off the parking lot, it depreciates. So that means the day that I bought it is the day that I'm going to start depreciating it. So again, June 8th is correct. You're going to depreciate it as of June 8th. And because of the rule that you said, because it fell before the 15th, that means we need to depreciate it for the month of June. Right? So in this case, now we're doing units of production. So what is the depreciation basis? How do I solve for the depreciation basis using units of production? What's my formula?
Cost of the asset minus the salvage value.
Excellent. So in this case, 32,208 minus 0 is going to give you 32,208.90. That's my depreciation basis. What's my rate going to be?
1 over the estimated life.
Not 1 over the estimated useful life. That's the huge difference between straight line and units of production is the rate. How do I figure out what my per unit rate is?
It's the depreciation basis over the estimated number of units in productive life.
Yes, correct. So in this case, what we're trying to figure out is how much would it cost me per mile if I used this truck. So I'm going to take my total cost which in this case, my depreciation basis is how much I can depreciate it for, right? And I'm going to divide it amongst the number of estimated units that I can produce that entire time. So in this case, I can drive up to 150,000 miles. That means I'm going to get a per unit rate. So every mile that I drive, this is how much it's going to cost me. So if I go ahead and do that, I should get 21.47 cents. Okay? That means every single mile that I drive, it's going to cost me 21.47260. Okay? So therefore, how much is going to be my depreciation expense if I drove 1,200 miles for the month of June?
$257.67.
Good. All right. Good. So then, of course, that's going to be your first one. So then what's my book value going to be?
$31,951.23.
Excellent. Good. Now, that's how much it's worth in case I do decide to say I'm going to sell it for the month of July. That means right now I can only sell it for $31,000. But if you sell it back to the auto dealership, they might take $5,000 right away because you used it. Okay? So they're going to go through appraisal and things like that. But in this case, right now, if I were to trade in right now, it should be worth $31,000 because I already used 1,200 miles on it. Okay? So now in this case, right, why do I not need to adjust this? Because in this case, I started it in June, okay, which is in the middle of the year. Why do I not need to adjust this number? Two reasons. Why do we not need to adjust this number?
Because we're basing it off of the mileage, not the age.
Correct. It's not time sensitive, right? We care about how many miles it drove. So that's correct. Second thing too is we're doing on a month-to-month basis. So in this case, it doesn't even matter. We're not counting in years, we're counting in months. So good. Excellent. So what I'm going to do here is what we're going to do is we're going to journalize the entire thing under one depreciation expense. Because at the end of the day, what you're going to be doing is they're all going to go under the same account. So we already know this is all going to go into depreciation expense. However, right, each one you do need to list it out as an accumulated depreciation and whatever the asset is. So if you take a look at your chart of accounts, when you look at all of your assets, right, especially your fixed assets, right, you have an accumulated depreciation, okay, for a table. You have accumulated depreciation for a counter. You have accumulated depreciation for a desk. They're not all collective under the accumulated depreciation. They're all separate. So in this case, right, I need to list out all my assets one at a time with the accumulated depreciation. Now, remember, this rule, historical cost, means you cannot deliberately change the value of the asset itself. You cannot write it off that the value of your asset is now $31,000. No, that's not true, right? Because you didn't buy it for $31,000, you bought it for $32,000. So once again, depreciation is going to be considered a non-cash transaction. However, when you do get rid of your asset, if you remember in chapter 11.5 and 11.5, when you get rid of your asset, that's where you also have to get rid of your accumulated depreciation. What is the book value of the asset? Did you gain money or did you lose money when you sold your items? So in this case, you don't recognize any gain or any loss until you dispose the asset. So in this case, right now, you purchase it at $32,000. It is on your books for $32,000. This is just a non-cash transaction because you need to find some kind of way to say that I used the asset. Because 10 years from now, I can't sell my car for $32,000. No way, because you used it. So in this case, in your books, it still says it's $32,000. However, when you put the accumulated depreciation, right, that's representing that you're using the asset, then that's going to reflect, because again, the accumulated is a contra account. So it will reflect the book value of your assets. Okay? So in this case, right, when we look at our chart of accounts, we have the accumulated depreciation for the truck, which is account 17011. Okay? I'm going to go ahead and just do the short accumulated depreciation for the truck, which is 11,710, was it? Let's see. 1711. Okay? And this amount was for a total of the $257.67. 25767. $25767. Okay? And like I said, what I'm going to have you do, instead of having to do each and every single asset item separately, since they're all going to the same account, just go ahead and make a huge list of all the fixed assets, because we're going to go down the line and calculate all of them in grand total and do an equal sum to determine how much depreciation expense you had in grand total of all of your fixed assets. Okay? They're all going to go to the same account, so there's no point to have to journalize this and say this is depreciation for the truck, right? We're going to list them all out, okay? But for now, I'm going to go ahead and stop here. Right now, it is 2:56. Let's go ahead and take our 20-minute break now, okay? So please be back no